Greetings traders, and welcome back to another survival guide. Chris here, bringing you some more information. Today we'll be talking about the Death Cross and the Golden Cross. More so the Golden Cross, because that's the term that most traders are familiar with when we talk about either of these strategies. And if you aren't familiar, then yes, you did hear me correctly. These are strategies. So we will be talking about this bullish and bearish strategy that are commonly respected in the trading world. But before we do, if you could click that like and subscribe button down below, I'd appreciate it a great deal. Thank you very much. Now, let's get going. The terms Golden Cross and Death Cross are very emotive, prompting thoughts of extreme gains and extreme losses. Luckily, this just isn't the case, as both of these can provide potentially lucrative trading signals in either direction. These indicators are often used in conjunction with other short-term indicators to help flag changing trends. Different traders have different opinions on the Golden Cross and Death Cross, and has been the debate of subject for some traders for quite some time, but one thing is undeniable: there are traders currently using both the Golden and Death Cross that are indeed happy with their performance. Let's start with what the Golden Cross is. In the eyes of many traders, the Golden Cross is the holy grail of bullish indicators. In order to flatten out short-term volatility, traders will usually use a 50-period moving average and a 200-period moving average. Due to the lag in the two moving averages, when a 50-day moving average is moving up through that 200-day moving average, this is often considered a confirmation of an emerging bullish trend. In theory, it indicates short-term momentum and a potential trend that is changing the direction. Let's talk about what the Golden Cross tells us. Well, obviously, if we encounter a Golden Cross on the charts, it's safe to say that there's never going to be any two scenarios that are exactly identical. But there are three distinct stages that the Golden Cross showcases, and these are buyers taking control of a downward trend as number one. By definition, due to the short-term weakness in the 50-period average, the Golden Cross will occur after a downtrend. The resulting strength in the 50-period average comes about when the short-term sellers dry up and the buyers begin to take control. The graph will level out, and then the buyers move into the driving seat with price moving higher. Then we also have the momentum moves the 50-period average through the 200-period average. This is key. If this upward momentum continues, then eventually the 50-period average will push through the 200-period average. This is the point at which the eyes of many traders start to light up, and they have to ask themselves, is this a new trend or a false flag? And then finally, we have consolidation, then resume the uptrend. When the 50-period moving average moves sharply through the 200-period moving average, this indicates strong momentum. Sometimes this can lead to short-term overbought situations. These are often reflected in technical graphs by a period of consolidation, sideways trading, or a partial retracement. This is key moments in the market when this occurs. If the asset price trend is changing, then eventually the buyers will regain control, moving the asset price to higher ground. Many traders make the mistake of buying too early before the uptrend has been confirmed and the period of consolidation has not yet ended. If you invest too early, you may encounter a pullback towards the end of the 200-period average and a retracement below the trend line. The degree of risk that investors take is reflected in whether they are willing to wait and see the trend confirmed and lose out on some of the potential profit opportunity, or if they want to jump in early at the expense of additional risk. Let's take a look at an example of a Golden Cross, and to do this we're going to use a chart from the E-mini S&P 500, and it will showcase what we have going on. So we have a 50-period moving average and we have a 200-period moving average. The 50 period is going to be the green line. The 200 naturally would be the blue line that is currently below it. And this goes back to a period of somewhere around July. And what we saw was that, as we had been talking about, the index began a period of consolidation and then briefly fell back below the 50 and 200 period moving averages. However, while the 50 period moving average remains above the 200 period moving average, the trend is deemed to be intact. As we can see from this shaded area, the index rebounded relatively quickly after dipping below the 200 period average. It was only in late October, early November that the Golden Cross was finally confirmed. While the investors were looking at this and going long on the E-mini S&P 500, they would have eventually made some profit from their long positions if they held long enough. This would have been a very interesting scenario though, and jumping in during the consolidation period can always be seen more as a gamble. Once the change in the trend was confirmed towards the end of this shaded area here, this resulted in a significant upward movement in the index and would be the ideal location that we'd want to wait for before entering into the Golden Cross for our long position. Now let's talk about the Death Cross. In simple terms, the Death Cross is just going to be the exact opposite of the Golden Cross, indicating the weakening of a bullish trend and the emergence of a bearish trend. Very often, due to growing short-term downward momentum, this can lead to a short-term oversold situation. It is not uncommon for the index level to rebound on or around the Death Cross date itself, much like an overextended elastic band that is pulling back. This is all part of the Death Cross process. It can prompt some inexperienced traders to jump in early, which is why we strongly encourage familiarizing yourself with the Death and the Golden Cross before jumping into the market on a live account. Looking at this graph here, with particular focus on this shaded area over here on the left, this perfectly illustrates the various stages of an emerging downward trend. As we can see, the index has been stuck in the trading range around this time for some time before sellers finally took control, allowing the index to drop down lower. Now, interestingly, the crossover period came just after a sharp sell-off. There was then a few days of consolidation, another sharp sell-off, and then another period of consolidation. Experienced traders would have waited until the emerging downward trend had been confirmed thereafter to jump in. Had we jumped in early, then we may have been in for a very uncomfortable ride during the consolidation period. Just like the Golden Cross, we want to get in once it is confirmed and not once we have totally identified. As we've mentioned before, we never want to just simply jump into a trade for one reason and one reason alone. It's always good to use layers of confirmation to help filter out potentially tricky scenarios. There are some Golden Cross trading strategies that we could definitely talk about. The first is when to commit to an investment. As we were talking about, there are very few, if any, Golden Crosses or Death Crosses which are not followed by a short-term pullback and a period of consolidation. So traders will always look for confirmation the trend has changed when trading intelligently, rather than slipping back into the previous range because they jumped in early and now their position is unnecessarily going for a ride. So at what point do we commit our investment? Well, we commit to an investment once we have confirmed the trend. Then we have using additional technical indicators. This is relatively straightforward. It doesn't matter what the technical indicator is. It could be the stochastic oscillator, Bollinger Bands, other moving averages, the convergence, divergence, or the relative strength index. It doesn't matter. The point is we can couple our already pre-existing knowledge of how we interpret information from other indicators to help confirm our identification of the Golden and Death Cross. And finally, we have don't forget to set stop loss limits. This is a very silly, easy process to follow, but yet a lot of traders just simply don't do it. A lot of traders feel that they're going to exit when they want to exit, and they don't set the stop loss ahead of time, and this can be a crucial mistake for just about any trading strategy. We aren't always going to be correct, and the moments that we aren't, even if we're correct more than we're not, those few moments when we're not correct, if we're not prepared with a stop loss, those losses can quickly erase a large series of wins that we worked so hard to achieve. So, in short, let's make sure we use our stop losses and have them in place before we open our position. The death cross trading strategy itself can be useful when looking to protect a profit itself from a previous position or to take out a short position. In reality, all of the options applicable to the golden cross trading strategy that we just discussed are relevant to an emerging death cross trend as well, so we don't need to repeat those. The trend is moving in the opposite direction. That's about where the differences end. In general, the majority of investors do tend to make a more optimistic outlook on the longer term, and as a consequence, when a sharp downtrend emerges, many investors are looking to bottom fish on the oversold positions. As a consequence, we often see a sharp or short rebound from oversold positions, which is a stronger pullback than from the overbought positions. So this is something to be aware when using the death cross strategy. While a bone of contention with many investors and skeptics also highlights that sometimes the death cross trading signals are not as strong as the golden cross counterparts, it is still a very useful strategy to be aware of. So between the golden cross and the death cross, which is best? Well, the concept behind the golden cross and the death cross itself is in fact identical, except one is going with the uptrend and one is with the downtrend. In theory, there's really no reason why either of these respected trading signals should be any stronger than the other, aside from the pretense that longer-term investing does usually favor the bullish outcome. But this does not mean that, once again, that the death cross should be thrown out. There may be difficult short-term scenarios where markets come under pressure and it's difficult to see any potential upturn. The coronavirus pandemic is an example of investors and markets looking to be positive but often finding few reasons to break free from the ongoing skepticism and the negative sentiment. When it comes to the specifics of trading based upon the use of technical indicators, it is important to be disciplined. History shows that us as investors will take profits quicker than if we cut our losses. This usually results in a better scenario for us overall. The idea of banking an attractive profit is something that is very appealing, yet for some reason a lot of traders just don't take advantage of it when they are in their profitable periods of their particular trade. The whole idea of technical analysis leading trading ideas is based upon discipline and interpretation. There will always be a degree of flexibility regarding interpretation of emerging trends, but discipline is something that comes with time and experience, so don't stress it out if you're not exactly where you want to be right now. But using sound-based strategies that others are finding success with is always a very good start to getting your trading career on track. So to sum up the golden and death cross trading strategies, we can use them as a valuable tool when we have practiced with them and we've understood them to their full potential. They're very valuable tools, and this has been proven time and time again by traders who are proficient with these strategies. That's not open for any debate, but the reality is you can also do poorly with these strategies if you jump into the waters before you understand the process or understand how they appear in various market conditions. The overall outcome in identifying the golden cross trading strategies is relatively beginner friendly because it only involves the 50 and 200 period moving average. I do recommend checking out some charts that have a demo platform like we have here on the Finamark platform to give yourself some practicing ability before you ever consider jumping into live markets and making some type of investment based on what you've learned here today. But until next time, folks, happy hunting, happy trading. I'll see you soon. Bzz.